Hello, everyone, and thanks for joining today's session on sustainable securitization and covered bonds. I'm Dennis Hoyer, Capital Markets Partner at Whiting Case, and I'm based in our Frankfurt office. Today with me, I have a great panel, and I have the pleasure to have two external speakers and two fellow partners with me. So from European Investment Bank, we have Daniel Farci. Daniel works in the Climate Action and Environmental Coordination Division, so is obviously well placed for today. And then we have Daniel Boutsas from UNEP-FI, which stands for United Nations Environment Programme Finance Initiative. So again, spot on for our session today. And then we have two of my EMEA Capital Markets fellow partners joining today, Ingrid York from a London office. Ingrid also co-heads our Global Financial Industries Group and is a member of the UK Task Force on Scaling Voluntary Carbon Markets. Last but not least, we have Debashish Dey. Debashish is based both in London and Dubai and is one of our most highly regarded securitization and DCM lawyers and certainly a pioneer in green finance matters. So with that, I would like to start with our external speakers. And I would like to pass the ball to Daniel Farci from EIB. And Daniel, I'd be keen to hear from you. What is your role at EIB and where do you think EIB is in the transition to a green bank? I'd also be keen to hear from you why you believe that securitization and covered bond products, which help bank with funding and capital relief, are critical for the transition to green markets. Thank you.
Thanks, Dennis. So I maybe say a little bit at first about, as you said, about EIB and where we're at and what we're up to. So to clarify, my title doesn't tell you much, but we made a number of big commitments as a bank over the course of the last year and a bit. And they imply such big changes internally that we've set up a special unit within our front office, our lending department, to try and figure out how we do them. It came from a place that we recognize that this huge financing gap for sustainability, for climate change, for environmental degradation. We want to be a big part of the European Green Deal and helping the EU meet its climate neutrality goals for 2050. And we're a sort of key implementing part of that. So we made some commitments, and I'll just briefly sort of mention them. We said that from the start of this year, everything we do, so all of our lending operations will be Paris aligned, so aligned with the 1.5 degree pathways. And that's, let's say we made the announcement, and now we're figuring out exactly what that implies in some ways. It's a big task. We're stopping from the end of this year all traditional fossil fuel energy lending, and we've committed that more than 50% of everything we do from 2025 will be in climate. And finally, by 2030, we will have supported 1 trillion euros in climate action, environmental sustainability investment. So, huge task internally, and we're trying to get there. To give a snapshot of where we were last year, approximately 26 billion financed in the green space last year, which is about 40% of our lending. So we're getting there, but a long way to go and a lot needed on our side. Then to bring it sort of to capital markets, as you know, probably we were early to recognize the importance of the capital markets and the idea of steering funding flows towards a kind of transparency and disclosed use of proceeds. So EIB, through its climate awareness bond, was actually the first, really started the green bonds market in 2007, providing that kind of extra level of transparency. Obviously, over that time, there's been huge growth in green capital markets. But I think to put it in context for us, it's still very small. It's still a sort of single digits of the total debt capital markets. It's still in some ways nothing where it needs to be. So I think that the funding gap is supposed to be around 350 billion a year estimated in the EU alone in terms of meeting targets. So we're sort of trying to see how we can do more. So we will continue on our issuance side, but now also on the investment side, we're trying to think what can we do, working on developing products where we're actually investing in green bonds, where we can act as a sort of anchor investor to try and pull the market towards the things that we would like to see grow. Probably in danger of talking too long, so I just briefly mentioned touch on the point about why securitization. So I think, and probably we'll hear from the much more knowledgeable colleagues joining on the call, but energy efficiency, for example, we see as a huge area where securitization could do a lot. It's a sort of it's an atomized investment space. It's a huge need for it in the EU, and I won't start tossing out figures because it will take too long, but it's big. And at the same time, we also see an EU where it's still primarily bank lending mediated financing for investment projects, and hitting capital constraints. So where, capital relief through securitization has a big role. I think I would couple that then with sort of also a cognizance of the fact that the market is not growing where we need to see it grow. It's not growing to the scale that we need, and so there's a number of barriers which I'm not the expert on, but I think are pretty clear. So we'd like to do our part in trying to address some of those, but also very aware that they're beyond. Many of them are also beyond us. I'll leave it there for time, but thanks for the question.
Thanks, Daniel. Going over to the other Daniel Buzas. So you work at this United Nations Environment Program Finance Initiative. Would you mind telling us what this is and how you scale up sustainable finance with this initiative? And same question as for the other Daniel, also to you. How do you believe, or why do you believe that securitization and also covered bond are instruments that should add to the critical mix to finance the needs that we have ahead of us?
Thank you, Dennis, and also thank you, the other Daniel, also for his remarks. On my side, to explain a bit what Uniphi is, we're an initiative of the United Nations Environment Program, so UNEP, to collaborate with the global financial industry in order to deliver sustainable development finance. So really produce sustainable results working together with the financial industry. It was created almost 30 years ago, and we engage with around more than 400 banks, investors, and insurance companies around the globe. And my specific role, I'm the European coordinator, so that means that I am in charge of looking after the European membership of Uniphi and all of the different relevant European initiatives that are happening in the region, which is quite broad, but it covers everything from UK, EU, Eastern Europe, Russia, and beyond. So that is quite a large membership, and actually 50% of Uniphi's membership is based in Europe. So that is a bit, let's say, the challenge that I have ahead of me, is to try to engage with institutions that are already quite advanced, but at different levels of development and with very different business model in a region that is primarily bank finance, which I think plays quite an interesting role in also how the products and the different, let's say, actions that financiers can take in order to actually make the transition to a sustainable economy a reality. So how do we actually do it at Uniphi? Well, we have, in 2006, we launched the Principles for Responsible Investment, that now it's managed by the PRI. So we have a sister organization that is managing these principles. So they have quite a large investment membership. They're doing quite a lot. But we also host at Uniphi the Principle for Responsible Banking and the Principle for Sustainable Insurance that bring together the banks and insurers that are willing to actually move forward and bring this change ahead. We're now in the process, let's say, the second anniversary of the Principle for Responsible Banking, and a lot of initiatives are happening. And more recently, we have also participated quite concretely in the G funds, so the Glasgow Financial Alliance for Net Zero that is led by Mark Carney, and we are the conveners of 3 of the 4 initiatives that are under that umbrella. There are the Net Zero Banking Alliance, Net Zero Asset Owner Alliance, and Net Zero Insurance Alliance, looking at not only how these companies can look into sustainability, but also to set commitments to reach the net zero targets by 2050. And we do so by allowing members to discuss, to put together, let's say, the different ideas and the different methodologies of how to do so, while providing, let's say, guidance on how to do so and a place to really, let's say, mark how they want to do these commitments. With regards to the products, I mean, I think, as I said, that this is a very interesting combination between financing, capital relief, and also allowing investors to chip into specific pools of assets that are relevant, as I say, not only for banks that are, in terms of sustainability, looking how to do this in the way forward, but also to do it in an effective way that is at the same time efficient in terms of their internal understanding of their treasury, etc. So I think that is relevant to understand that sustainable finance can happen in many different ways. And if Europe is a, let's say, bank finance economy, how can actually banks continue that process forward when you have like many loans that are going to come in the future, like Daniel was identifying before on energy efficiency? That's going to be probably the biggest pool of green assets that we're going to have in the way forward. And if those are going to come in a concrete way to help banks as well, not only the clients and the customers that are benefiting from the financing, it can be quite concretely through these products. And I think I will stop here. I've also been talking for some time, but that can be the gist of it.
Thanks, Daniel. I think that's a good point that within Europe, continental Europe, we still have a big share of credit institutions with bank lending markets, right? And in order to be able to transfer the credit risks and to ensure funding and refinancing, I think securitization will add to the critical mix of that. Debashish, so you're focusing on cash securitization and on covered bonds, and I'd be keen to hear what you have seen recently, how to make these products more ESG friendly. I'd also be keen to hear what you think matters most. Is it the asset pool? Is it the use of proceeds? Or should we introduce structural features that are linked to certain ESG KPIs whereby payments depend on whether or not these KPIs are met? And do you see any difference between cash securitization and covered bonds? So would be interesting to hear from you, your thoughts.
Thanks, Dennis. So if you asked me 2 or 3 years ago what the future held for ESG linked securitization, especially on a cash basis, I would have said, at least outside of North America, where there's definitely a developing market based around a lot of finance related to energy efficiency, solar panels, etc. I would have said, look, the prospects aren't that good. There are a couple of reasons for that. The headwinds are, first of all, as you, Dennis, and Ingrid know, the environment in the EU, from a regulatory point of view, has not been that benign for securitization. It has been very challenging for a variety of reasons for the product to reach the levels that it did pre-financial crisis, simply because I think from a regulatory point of view, there's still a bit of a misunderstanding that actually de-risking banks' balance sheets through securitization is actually the right thing to do, particularly if we understand the product as a product that is actually, not some of the quote unquote bad products left over from the pre-financial crisis, but actually, products which are transparent in terms of performance. But the major issue I think we saw on cash securitization of ESG type securitization was the lack of supply of green assets. To your point, typically in a use of proceeds bond, which is ESG linked, the company has 2 tests to make. The first is its balance sheet, is its business compliant in some way with ESG principles? And that's a spectrum that goes from very, very hardcore assessment to a bit softer. And then also, what are the use of proceeds for those funds that it's raising through a non-securitization ESG bond? For securitization, it's actually a double or triple whammy test, because for a cash securitization, you're asking first, is the business that is the originator of these assets, where is it on the spectrum of green policies, ESG compliance, et cetera, just from a hygiene point of view, from an investor point of view. Number two, what are the proceeds going to be used from the securitization? And one could argue that actually that's an easy test. You're using the proceeds in a securitization from a cash point of view to buy the assets. That's what the investors is doing with the money. And so in some ways that test is actually more easily satisfied than a straight corporate balance sheet ESG bond, because it's defined already. We know what the proceeds are being used for. But the third question becomes a little bit more complicated, which we don't necessarily have in an ESG corporate balance sheet bond, but we do on a cash securitization, which is, okay, we know the use of proceeds are being used to buy the assets that are being securitized, but is that pool of assets? And that pool of assets is where our problem was for the last 2 or 3 years, because originators did not have a large enough supply of ESG compliant assets. If we take the example of, say, the residential housing market, well, it's difficult for an originator to say, in current loan portfolios, that every loan they have is an ESG compliant loan, because that's not how the housing market works. Now, increasingly what we are seeing is that there are criteria being put in place, and particularly for new builds or for home loans being used to make homes more energy efficient. You could say that that category is growing, but it's a small pool, and it's certainly not large enough to sustain a securitization of any meaningful volume over the next few years. So what is our hope? Our hope are ESG linked instruments, but not necessarily ESG securitization as we know it, but sustainability linked. As you said, Dennis, KPI indicia, where we seek targets, and those targets actually relate to measurable constraints or measurable performance indicia that may or may not relate to the pool. And we have done a deal like that, actually. And the firm was very pleased to work on a transaction where both the European Investment Bank and the EIF were involved in a transaction which involved a major auto rental entity based in Greece. And in that transaction, there were KPI criteria put in place that said, to the extent that we invest in this securitization, we have linked KPIs that we want to understand that over the next few years, in a measurable way, you will invest proceeds into energy efficient vehicles and charging stations. And I can imagine that those measures being looked at alongside a pool that may be not fully compliant will be the way to expand this securitization product, which is sustainability linked, KPI led securitization. Last bit, just because again, I'm trying to stay on time. Sorry about the long-winded answer. You asked about covered bonds. I think covered bonds is another very good example of doing this. Now, covered bonds are not fully securitization in the classic way of where we're, disaggregating the risk from the balance sheet of the bank. Covered bonds are a hybrid product where we really have a covered bond. It's a bond of fundraising by the bank, covered by a pool of asset-backed security, a pool of mortgage loans. And that hybrid product actually has a very, very good future in sustainability-linked covered bonds. Hasn't been done yet, but it's a great idea. And how would it work? It would work with us doing a traditional covered bond, but what we would do is layer into those covered bonds KPI, which would lead to up or down adjustments of interest rates on the covered bond based on the fact that the bank would be seeking to achieve measurable performance of doing certain ESG activities. That could be within a social impact, that could be within energy efficiency. So say completely unrelated to the cover pool, lending more in energy efficiency arrangements looking to help homeowners improve their homes. It could be governance, which is changing the nature of the workforce, seeking balance and diversity within the bank. And all of those allow for greater flexibility and a greater future in doing these types of instruments. And lastly, I would suggest that we need to do this anyway, because as Daniel have said, there is an investor base and an institutional base out there that are looking for ESG. They're essentially saying we've got to have investments that are ESG compliant. So I think all of us therefore need the securitization market to come up with products that are amenable for that. Thanks, Dennis. Back to you.
Thanks for your insights, Debashish. Ingrid, over to you. You are acting on a number of synthetic securitizations, also called on-balance sheet securitizations. That is typically when banks try to bring down their RWAs, leave the assets on their balance sheet, but buy credit protection from third-party investors, and thereby do a synthetic securitization. So these products are a bit different than cash securitizations and covered bonds Debashish talked about. What have you observed on these products in terms of looking at the asset pool, the reference pool, and or looking at ESG KPIs that are linked to investor payments or the use of the capital benefits? Could you share some of your experience, please?
Yeah, sure. Thanks, Dennis. So you may or may not be aware that there's actually been quite a few large synthetic sustainable securitizations in the market over the last few years in Europe, which is very exciting. They have been a variety of, or they've combined a variety of sort of the key three features that you've mentioned. So we've had trades where the underlying portfolio was a sustainable asset pool, but obviously we've only seen a handful of those deals, and we need more volume in those assets for this type of trade to really get going. And obviously that's for the reasons that Debashish and others have mentioned. We just don't have the volume of sustainable assets right now for those type of transactions to be the key ones going forward. Obviously that will remain to be seen if we see more of that. The second one, and I've been involved in 2 transactions in this particular category, is when the capital benefits are applied towards sustainable goals, and obviously that's sort of the use of proceeds transaction. And I've been involved in 2 trades. The first was where the capital benefits were deployed directly to fund sustainable lending, or alternatively, the second category being where they are used to fund a positive impact factor to facilitate that sustainable lending. And the last category, the sustainability linked, which is what Debashish was mentioning, where there's embedded ESG KPIs in the instrument itself, which impact the cash flows of the transaction. I've done a transaction which had a step down in one of the particular cash flows where certain tests were satisfied. And I guess in the synthetic space, what we could see there is where, for example, the collateral pool meets certain tests, perhaps initially or over time or whatever it is, or the use of proceeds are applied in a particular way, and there's particular ratcheting or thresholds in respect of that. Or alternatively, there could be separate KPIs around, as mentioned by Debashish, perhaps around the institution itself, or entirely separate KPIs in relation to the transaction. So those 3 particular features could exist in a synthetic, or have existed in synthetic securitizations on the ESG front already. And you could imagine that you could apply or combine any 3 of those particular features in relation to a particular transaction. So as for what you would focus on or what would be available to you, I mean, it's really a question of various factors. Obviously, the first one we've talked about, the supply of sustainable assets, that's obviously a really critical one. And if we go down the KPI or the sustainability linked route, really what you're comfortable with as an institution, which feeds into considerations and constraints around things like data, your operational capabilities in terms of monitoring and reporting and disclosure on the transaction. And then we have obviously a whole raft of additional and perhaps new legal risks and issues around reputational risk, claims of greenwashing, all of that stuff, which is obviously very, very important to any originator or issuer in this space that cuts across all of the products, to be frank. I mean, that particularly greenwashing, that is an extremely hot topic in this area. Whenever we talk about ESG now, we have to address and confront that issue. In the transition period, and I'd like to call us, to be frank, in a transition period, it would be really fantastic, I think, to see the market grow in all of these types of assets, or rather sustainable securitizations. I know we've heard from some market participants that, it would be better if we don't just do use of proceeds trades, for example, and rather that, KPI linked should be the only way we go or whatever it is. But I think at least in a transition period, I'd like to see that everything is on the table. And I hope, obviously, the EBA is coming out with a paper next month on sustainable securitization. I would very much hope, and I assume that there will be a definition of sustainable securitization in that paper, and that definition will be broad and will be forward-looking, and it will acknowledge that we are in a transition period in relation to this product. And hopefully there is flexibility in that definition, and we can see, as I said, any trades with any of those features or a combination of those features or other features, to be frank, in the sustainable synthetic securitization space. Back to you, Dennis.
Thanks, Ingrid. And so one question from the audience, perhaps we address that real quick. That's for you, Debashish, on cash securitization structures where you mentioned that the use of proceeds for the sale of the assets are invested. What does this count for ESG analysis purposes? What would you say on that?
Well, this is an interesting thing. Thanks, Dennis. And it's an interesting question. So I would argue that it does if the underlying assets are compliant. So let's think about this. You're essentially saying on a cash deal, I'm taking the proceeds of the bond and I'm using them for a particular purpose, which is what are the use of proceeds? The use of proceeds are typically being used to purchase assets, which for the purposes of a securitization need to be compliant with ESG principles in order to say that securitization bond is a green bond. And so, somebody would say, well, do we need to go one step further? I'm thinking, I'm not sure why you would, because you've already effectively said that the pool that's being monetized are the underlying green assets. And that is the pool that's generating the return that is actually green or ESG compliant. So I would argue that you should be looking at the underlying asset pool that is essentially being monetized and not necessarily some other use of funds, because broadly speaking, once the use of proceeds test has been satisfied with the capturing of those assets, then the funds end in the general funds of the company. And there you're assessing, is the company ESG compliant anyway from a policy point of view, which is the first test I mentioned. Back to you, Dennis.
Thanks. So rather one-step approach than kind of double review of the use of
correct. Otherwise, you're just effectively making it, even harder for that company because it has to pass a whole series of tests that a corporate bond wouldn't have to.
So back to Daniel Farchi from the EIB, listening to the different features that we may have both on cash securitization, covered bonds, but also on synthetic securitization, it becomes clear that the market is still implementing different ways how to make these products ESG friendly. So we are not yet there with standardization, and I'd be interested to hear your views and observations, and also what you think will be critical in terms of finding standardization and also avoiding fragmentation by having too many different features. We know that we're striving for a capital markets union and also want to incentivize investors outside of the home countries of the issuers to buy into these products, and therefore the more standardization probably we can have, the better it is. But happy to hear your views on that.
Yeah, it is an interesting discussion, and I would say at EIB we were really founded on the idea of investing in projects. and it's in our constituting documents that we are there to finance projects. And the way that EIB has interpreted that since the beginning, basically, is CapEx. So we finance investments into the creation of assets, which means we tend to focus more on the use of proceeds, and that's really where the thing we're looking for. So I mean, we're looking at developing a KPI-linked product as an investment, let's say. Of course, they exist already. Could we invest in them? But in that case, it would be tied to use of proceeds as well, in all likelihood. So KPI with some of the features that those loans typically have, but at the end of the day, also that our money is going towards investments, towards the creation of assets. I think Devishish made some interesting points about do you look at do you look at both, or do you look at both sides? So the assets that are being securitized and the use of proceeds, and made the argument that it should really be focused on use of proceeds. I would tend to say that's probably our view of things, that's really where we're focused, right? But I do think actually we're also, at least to date, interested in the assets being securitized as well. I mean, is that absolutely essential? Because I take Deresh's point about the pool of assets is limited. I don't know. I mean, I think that's what we've looked at so far. But you have to think about maybe there is some compromise there with assets which are neutral. We would, for example, be extremely worried to check that we weren't doing green use of proceeds but backed by brown assets, for example, this kind of thing, which would be a concern. I think also Devishish mentioned this EIBs securitization. Just to give you an example, actually, I don't think that was EIB. I think that was EIF, our subsidiary, and EBRD, if I'm not mistaken. I may be mistaken, but I think that's because again, because of this CapEx focus we have. So I see all of these arguments for broadening it out, but at least as an institution, we're really focused on this creation of eligible assets, and that's how we look at the world, the filter through which we see the world. On fragmentation, I would look. I think within the EU, things are, the Commission's really forging ahead with sort of definitions of the taxonomy, which we participated heavily in the formation of, and as a result, frankly, reflects quite strongly the way we see the world in terms of investment in assets. For better, I hope, but maybe not everybody agrees with that. We're working with the Chinese, for example, with China on common ground taxonomy to look at where our taxonomy, the EU taxonomy, is the same. And I think there is growing common ground. We will be exploring other areas, but there is this kind of growing consensus around what's green. I think that will also apply more and more to securitization and to defining what that means. What does a green securitization mean? I'm not the expert, and I'm aware that the lawyers on this call are, but I mean, my sense, which I'd love to hear your response on, would be that the sort of the fragmentation at the moment is more in other areas, not necessarily on what's green, but is on the regulatory frameworks, on tax treatment, on various issues which prevent that sort of closer capital markets union or slow it, impede it to some extent, versus necessarily the green, which I feel like there's a growing consensus on. I'm also curious to hear, I just throw it out there maybe as a question, but with SFDR coming down the pipes, I wonder what that will do as well towards steering investor demand. This is, as many of us have raised, there's this huge investor demand, and once asset managers have to start asking investors' preferences for whether they want to invest in sustainable assets, one would expect that would lead to an even larger demand. And I wonder how that will push these kind of questions of classification and a kind of unification of what it means to be green and so on. But again, I don't have any answers there. I think it's an interesting question, so I throw it out there.
Daniel Bouzas, perhaps you can try to take the question and can also let us know, what are your observations on the different features on the products we have been discussing, and also I'd like to hear your view what you see as challenges right now, perhaps more specifically in continental Europe, given that this is your main focus, as I understand, and I'm sure you also see regulatory challenges, but perhaps also with respect to data. So what are your views?
Yeah, thank you, Dennis. And I think the very good questions posed by the other Daniel are very relevant. But I think that both Debashis and Ingrid have also touched on regulation, even though on different areas, because if I believe correctly, Debashis was referring probably to the STS securitization regulation at the EU, that there were some impediments, some challenges, how to put it forward. Then Ingrid was referring to the paper that the EBA will publish, etc. And now Daniel, with all of these concrete elements on the taxonomy, the SFDR, I think all of this is playing together. And one interesting thing that I may note is like in the renewed sustainable finance strategy that the EU put forward earlier this year, during the consultation period, there was the option on discussing a standard for EU green securitization. But right now in the strategy, that is not there anymore, because I think the priorities have a bit shifted to really define, to really go to the taxonomy and to look into what is happening there. Because what is coming, especially with the Article 8 of the EU taxonomy, is the disclosure by all of the relevant economic entities at European level, besides SMEs, which is a bit tricky because they are the majority, but large companies, banks, investors, they will need to disclose their alignment with the EU taxonomy. Not right now, not from next year onwards, but from 2023 the companies, 2024 the financial institutions. So from that moment on, the underlying assets will be somehow tagged already with the sustainability performance. So you will have already a pool of assets that is there that you will be easily, let's say, assessing how taxonomy compliant they are. And when you have that, the kind of things that you can do with that tool, it's, potentially limitless if you think about it, in the way that, you can structure KPI-linked loans with taxonomy performance indicators. If those loans are performing well, or even without needing to be those loans, you can then use it as an investor to say to the bank, okay, I see that in your balance sheet, your portfolio, you have this, and this levels of taxonomy alignment, you have these sectors that are being covered. What about we discuss how to pull them together into a package and understand how this can be moved forward and which kind of extra capital is going to be freed and to which kind of projects you can, let's say, apply it. And that I think is the beauty of the EU approach of defining things that is not completely, it's quite to the detail, but at the same time, it allows you within that rigidity, let's say, and the concrete definitions to develop the tools and develop the possibility to use what it is provided in many different ways. Then with regards to the data challenge, this is going to come together with the disclosures. Companies are going to have challenges to disclose. Banks are going to have issues to collect information, especially if they want to use the taxonomy beyond the mandatory uses, but for example, to non-EU companies or to SMEs. That they are going to be part, of course, as well of the value chains of the large companies that will require some information, but that is going to be the issue. And then also in the Capital Markets Union Action Plan, there was an action to develop a European single access point for all financial and non-financial data. If that actually becomes a reality, then you will have a whole array of tools that can be used in combination with the tagging that the taxonomy brings. I think I will stop it there. I know that, for me, the key element here is the interlinkage between banks and investors and how that can bring together interesting topics in the way forward.
Okay, thanks, Daniel. Back to Ingrid on synthetic trades. The EU legislator gave synthetic securitization or on-balance sheet securitization a huge push by introducing the STS label quite recently, which gives an additional benefit, capital benefit, to the banks who are doing these deals. Would you expect that ESG will further push the product and make it more user-friendly and more standardized?
I think definitely that we've seen already a lot of precedent transactions. We've seen that there's demand for this product, absolutely. And as the demand for sustainable debt increases across the board exponentially, whether it's, debt capital markets generally, equity capital markets, high yield or whatever, I would assume that we will see commensurate growth in this particular area. I could easily see, as we go through, as again mentioned, this transition period, that we might see tighter features on transactions such as, caps on brown assets in the underlying pools, perhaps over time. Maybe we have day one or replenishment eligibility criteria that is, moving towards a greener type of transaction over time or greener lending. I would hope that we'll have more ambitious KPIs and maybe other different types of trade adjustments that we see, that the ESG features get more front and center and more prevalent in the transactions and make the transactions more attractive for a broader base. Obviously, we haven't touched at all on what's very important, particularly in the synthetic securitization space, is the capital. And particularly, we know that we're waiting on regulators' guidance on brown and green risk weights. And I think as we see that come out, we'll obviously see, first of all, we'll see more synthetic securitizations for a fact, obviously, as banks look to get more brown assets off their balance sheets. And also, there'll be obviously a bit of both a carrot and a stick there, right? So obviously the movement to green lending just by way of that particular initiative. So I think, to my mind, the development in the capital, in respect of the treatment of capital, is going to be very, very important in any discussion around ESG, and particularly in the synthetic securitization space where, most of these trades are for Reg Cap purposes. Okay. Back to you, Dennis.
Super. Thanks, Ingrid. So in light of timing, last question to Debashish. The cash securitization and also covered bonds rely on ratings. So credit rating agencies are focusing on the credit quality and not on ESG, but ESG is now coming in and being added to both credit quality but also some separate ESG quality ratings. And I'd be interested in your view how this plays out for the investor base going forward. In the financial crisis, we had a discussion about ratings and investors relying on rating agencies, and after the crisis, many people said investors cannot close their eyes and over-rely on ratings. They need to form their own view, or at least be able to scrutinize the ratings. What's your midterm view on ratings that include ESG elements and investors kind of looking at this in order to satisfy their own needs and requirements?
Thanks, Dennis. And I should say, Daniel Farchi, you are right. I apologize that it was EBRD and EIF and not EIB, so I'm sorry for calling you out. But effectively, you're correct, which is institutionally, that's the ecosystem that you're mentioning. Well, I think, Dennis, this is an interesting question because all ESG finance really is driven by outside expert reports. It wasn't necessarily the rating agencies, but there have been a number of expert providers of opinions in this area that are actually essential and part of the investment analysis that's typically done before an investor buys a bond. Usually that report is commissioned by the issuer of the bond or the originator, but it's definitely an outside report. And in a way that's similar to what the rating agencies are also done. They're often retained by the issuer to provide a rating on the credit strength of the issue. Now, it's interesting that the rating agencies moved into this space because obviously they realize that this is part of their surveillance type of ambit. But, I've always questioned how necessary it is that they move into this space because, as you mentioned, it sits alongside the credit analysis. And obviously during the great global financial crisis, one of the big challenges we had was that there was an argument that investors were over-reliant on that credit rating. But that's different than an ESG rating. An ESG rating, I would think, is really very much an ethical rating. It's not a credit strength rating. It's not about how strong this company's ability to repay you might be. But it's actually instead a question of how closely does this entity comply with the metrics we're measuring ESG by. Now, going forward, that may be a taxonomy question. But today, it's been a question of a variety of things, which is the company may have a variety of policies around diversity, environmental friendliness. They may be a variety of other things that, are measured by these outside experts in addition to the use of proceeds and whether the proceeds being used are correct. But that report is still going to be assessed by the investor from an ethical point of view. And I'll give you an example. A recent example that I thought of in first blush, I thought was compliant, and then I was told was not compliant. So a company was clearly using funds to raise funds for a large-scale hydroelectric project where a dam was going to be built. And they commissioned an outside report for the effectively environmental impact. And the point that the report was focusing on is by bringing in this hydroelectric dam, they will effectively reduce carbon emissions from the coal-fired stations that the state was relying on. But interesting enough, the report also spoke about the impact on the people around the dam and the amount of hectares of land that would be flooded. Now, the report was essentially making this transparent. The investors were deciding from an environmental impact point of view, which was more important, the carbon reduction or it was the impact that the dam might have on the surrounding environment. That, to me, fine. If a rating agency wants to assess that as well, fine. I'm not sure they have the expertise, but it's really up to the investor at that point, not assessing the credit strength of the party being able to pay back the bond for the hydroelectric, but whether this or that impact affects their view of whether this is an ESG compliant bond. And I'll stop there. Back to you, Dennis.
Thanks, Debashish. And we're receiving a lot of questions on all of this right now. Unfortunately, we have to wrap it up because we have come to the end of the session. And but there's lots of questions on who gets to determine whether this is compliant, yes or no. Is it the investors? Is it the asset managers who are representing the investors? What is the basis? What are the materials? What are the numbers you need to look at for the asset managers to make that determination? And so I take that there's a lot of interest in all of this, that there will be follow-up questions which we will be happy to answer individually. And therefore, thank you very much, everyone on our panel today. Daniel Faci from EIB, Daniel Buzas from Uniphi, Ingrid, and also Debashish. I think it was a short session, but we tried to cover as much as we could in the limited amount of time we had, and looking forward to do more in the future. So please feel free to reach out to the individuals, and thank you very much for having joined our session today.